Welcome back to Intermediate Accounting, Volume 1. We are working on Chapter 4, Reporting Financial Performance. And the learning objectives for this chapter are listed here. We're going to learn about the creation of value and the management of performance, so particularly focusing on the income statement. We'll talk about the user's application of information about performance. So users are people who use information, financial information, to make user decisions. So the focus of our accounting is to help them to make those decisions. We'll talk about quality of earnings and what that means. We'll talk about measurement of income and differing perspectives on how to do that. We'll talk about measuring and reporting discontinued operations separate from continued operations, because of the fact that discontinued operations are only a temporary impact on this period's financial statements and won't have the same impact in future years. We'll talk about the income statement, the statement of comprehensive income. The income statement is the term for ASPE, and the statement of comprehensive income is the statement which we use for IFRS, International Financial Reporting Standards. We'll talk about the statement of retained earnings and the statement of changes in equity. Once again, statement of retained earnings, ASPE. Statement of changes in equity is IFRS. And then we'll talk about analysis, application of the financial statements, in particular the income statement, to assess the performance of a company. We'll talk, as we go along, we'll talk about differences in accounting between IFRS and ASPE. And then at the end, we'll talk about some of the changes that are happening in these financial accounting standards at the international accounting level. And that'll be enough for Chapter 4. So this slide shows a basic outline of what we just said. So once again, we just talked about them in terms of learning objectives. Here they are listed in terms of the order in which we're going to approach them today. Chapter 4 presents a detailed discussion of the concepts and techniques that underline the preparation of the income statement and the statement of retained earnings, statement of changes in shareholders' equity. So the requirements for adequate presentation of reported net income are described and illustrated throughout our discussion today. The relevant financial accounting standards are listed here. So these are the topics which are covered in the course. The ones which are listed as section numbers are ASPE standards. The ones with the IAS and IFRS references are, of course, in the IFRS part of the handbook. So as they're listed here, income statement presentation, purpose, and scope. The general standard, of course, is section 1400, IAS 1, which also covers the income statement presentation, purpose, and scope, which is covered as 1615 or section 1520 in the ASPE standards. Presentation for discontinued operations in section 3475 in ASPE and IFRS 5 in the international standards. Statement of changes in shareholders' equity and retained earnings, section 3251 at IAS 1, and other comprehensive income is not applicable for ASPE, nor is earnings per share. Both of those are covered as part of IAS 1. And accounting changes, section 1506 in ASPE and IAS 8 in the international standards. Now, we've discussed in the introductory financial accounting course, and the basic idea of accounting is to reflect the transactions of a business. And in general, the business model, businesses do three things. They, I suppose that because they're doing operations, they use the assets that they have and their human resources as well to generate profits. And by profits, we mean an increase in value. So taking resources which have been given to you and creating something of extra value that your customers are willing to pay you for. That would be the operations. In order to do that, they need to buy assets and invest in their human resources as well. And to do that, they need to obtain financing. So usually that comes in terms of debt or equity financing capital. So the financial statements that we are going to generate need to reflect these three different areas of business operations in a meaningful way. So it kind of works in a circular fashion here. As the business grows, of course, they invest in more assets and use them to create additional value, and they need to obtain adequate funding to do that. And in our corporate finance course, we talk about the risk of growth. Growing bankrupt is the term that we use there. Growing bankrupt means that you're growing too fast to actually fund the asset increases, the increase in asset values, and so you want to avoid that. So one of the things we discuss there is the prediction and planning for growth, and so that's an important part of the application of financial statements. We're not going to talk about that in this chapter. We're going to focus on the income statement. And the purpose of the income statement is to help users evaluate past performance and profitability, so looking at a stewardship function, how well management is exercising their stewardship obligation. We'll talk about using that information for predicting future performance. There's a component of it, the income statement, which is expected to be permanent, so it's expected to be replicated in future years. And there's a component which is viewed as transitory, and we treat them separately. So for example, unusual items or discontinued operations would be transitory, and so we wouldn't include those in the main body of the income statement. We'd separate them out because they're not going to be there next year. And then we'll talk about using the information on the income statement to look at the risk of not being able to achieve the expected future cash flows. So what are the risks of not being able to continue the so-called permanent performance? And so that depends on things like price risk and foreign currency exchange and a number of different factors. And so the performance, which is shown on the income statement, should help you to assess that possibility. Limitations of the income statement are shown here. The income statement measures the success of enterprise operations for a given period of time. So the statement assists the business community in determining profitability, investment value, credit worthiness of a particular business enterprise. The income statement provides investors and creditors with information that helps them to predict the amount, timing, and uncertainty of future cash flows. And so those are key uses of the income statement information: amount, timing, and uncertainty of future cash flows. So as we say in the corporate finance class, finance is all about cash flow, timing, and risk as expressed in usually in the discount rate. That kind of applies here. So we use the income statement. Using the income statement, investors and creditors are able to evaluate the past performance and determine the risk of achieving those future cash flows. So secondly, the data that accountants use in measuring the entity's net income must be susceptible to reliable quantification. So this approach has been criticized by economists for failing to include any of the qualitative benefits that they include in their definitions of income. But accountants are aware that income often includes qualitative aspects. However, these qualitative aspects have usually been discarded by accountants in determining net income because of the difficulty involved in their measurement. However, this limitation, along with the use of estimates, the choice of accounting methods, and how to measure net income, reduces the usefulness of the income statement. So we recognize that the income statement doesn't measure qualitative items adequately. In terms of the annual report, a lot of the qualitative items are discussed in management discussion and analysis in general ways. Because it's really difficult to measure them, we don't put them on the income statements. Some of them, of course, are included in the notes to the financial statements, but in general, the qualitative items are very difficult to put on a set of financial statements. So one of the things that management discussion and analysis does discuss in some detail is the risk that is associated with the operations of the company. The income statement helps users of financial statements to evaluate the past performance, to provide a basis for predicting future performance, and assess the risk or uncertainty of achieving those future cash flows. So the limitations of the income statement include the fact that the items from the income statement there are items on the financial statements on the income statement which cannot be measured reliably, and so there's some degree of judgment, some degree of estimation involved with those numbers. The income numbers are affected by the accounting methods employed, so where we have accounting method choices, we need to disclose those methods in our notes to the financial statements. And finally, there's a substantial amount of professional judgment which is required. So part of this course's objective in general is to help you develop some measure of that professional judgment in determining how to disclose transactions properly to minimize the I guess the unreliability of the measures. Quality of earnings. Quality of earnings is important because markets are based on trust, and it's imperative that investors have faith in the numbers reported, and if that trust is damaged, then capital markets will be damaged. There's some good examples in Enron and WorldCom. Here in Canada, Nortel would be an example of corporations whose managers disclosed information which was later found out to be less than full disclosure of the transactions of the business. In Enron's case, they were making up things. In Nortel and WorldCom's case, their accounting choices were biased in favor of management, and as such were not properly representative of the transactions of the business. So quality of earnings is a bit of an issue that we need to consider. In Enron's case, the effect of Enron's bankruptcy removed trillions of dollars from the U.S. capital markets, and so it's a significant issue in that particular case. But in general, if the users of financial accounting information can't trust the financial statements which are being given to them, they probably will reduce their investments in the market. We call that adverse selection, where they select out of the market because they can't trust the information, and management definitely would have an information advantage, and so they certainly could profit from being able to deceive investors and get them to invest where they should not invest. And so that market failure of adverse selection would have a detrimental effect on our capital markets. Accountants then must ensure that financial information is unbiased, that it reflects reality, what's actually happened, and is transparent and understandable. So capital markets will value information as high quality if it's free from earnings management by the managers who control the presentation of the financial accounting information. Reliable information can be used by capital markets to determine if earnings are sustainable, and that helps them to determine whether they wish to invest in those companies. So in terms of the quality of earnings, high quality of earnings would be viewed as unbiased and objective, represents economic reality, what actually happened. It reflects earnings from the core activities, so we separate out discontinued operations as a result of that. It is usually thought of as being correlated with cash flows from operations, and so one of the measures of quality of earnings is the degree to which operating income agrees with cash flow from operations, because if it's in cash, we know that management has it's very difficult for management to bias actual cash flows. They can choose the timing to some degree, but cash is basically where everything comes to rest in accounting. So it's kind of the numeraire asset, as the economists say. And so when things are measured in cash, we know that there's a high degree of objectivity. So one of the proxy measures that we use in research for quality of earnings is the degree of conformity between cash flows from operations and operating income. And presentation, issues of presentation and quality of earnings. We want to make sure that the disclosure is transparent, by which we mean that people can read the information and understand it, and not have things hidden from them. It's understandable in terms of if you have a reasonable degree of understanding of business transactions and of financial accounting standards, you should be able to determine what has actually happened with the business. The information should be clear and concise, so that it's not hidden in a volume of information, and it can be applied to the user's decisions. Earnings management by managers decreases quality of earnings because it allows them to use accounting methods to change the cash flow from operations, the correlation between the cash flow from operations and the operating cash flow, in a way which is often seen as serving their own interests to the detriment of investors and society. And so that's not necessarily a good thing. It's also not necessarily a bad thing. We can look at some of the research referring to earnings management, and one of the things that earnings management does allow managers to do is they can adjust their income statement measures to reflect what they believe the long-term implications for the organization are. So they might adjust income to what they think is a replicable or repeatable level of earnings, despite the actual cash flows of the existing period. And that is viewed by a lot of people, a lot of researchers at least, as being a valid use of earnings management. So it's not necessarily a bad thing. Managing earnings is not necessarily a bad thing. It depends on whether it is done to bias the information in a way which helps management, or whether it's actually an attempt to disclose inside information in a way which is usable for the users of that information. Comprehensive income is a relatively new term. In the last 2 or 3 decades, we changed to including comprehensive income in addition to net income. And so items that bypass the income statement are included under the concept of comprehensive income and are added after net income in calculating the total comprehensive income for a firm. They're reported essentially directly in equity. They don't actually show up as net income until they're realized. And so comprehensive income includes all of the changes in equity during a period except for those resulting from investments by owners and distributions to owners. Comprehensive income would include net income plus any gains and losses that bypass net income. So gains and losses, excuse me, gains and losses that are unrealized in cash, and but they do affect shareholders' equity. They do affect the value of the company, but they're not measured with enough reliability that they should be included in regular net income and used to measure management performance. So common comprehensive income measures which are not included in net income would be foreign currency translation, or changes in value in sort of the paper or book value, or not the book value, the paper value of financial securities. So an example of an item that would be included in comprehensive income but not included in net income would be unrealized gains and losses associated with available for sale securities. We'll talk about those a bit later in the course, but these items that bypass the income statement are often referred to as other comprehensive income. The Accounting Standards Board has decided that the components of other comprehensive income must be displayed in a separate financial statement or an expanded income statement with the same prominence as the other key financial statements. So regardless of the format used, net income must be added to other comprehensive income to arrive at total comprehensive income. ASPE continues to focus on net income, and so the other comprehensive income is not accounted for in ASPE standards. For the most part, accountants tend to agree on the composition of items which should be included on the income statement. However, certain unusual items have stirred controversy in regard to the effect they should have on the presentation of net income. Some accountants favor an all-inclusive approach that reports the unusual items directly in the financial statements in the income statement. Those who support the current operating performance approach to income measurement, so the two choices are all-inclusive approach or current operating performance approach to income statement presentation, believe that the unusual items, those who support the current operating performance approach to income measurement, believe that the unusual items should be disclosed, should be closed directly to retained earnings, the so-called dirty surplus approach, the term that was used in the past. So clean surplus would refer to the all-inclusive approach, where everything goes through the income statement. The current operating performance approach would be what's called the dirty surplus approach, because the surplus is the retained earnings, and the dirty surplus would mean that things are in there which have not been properly cleansed through the income statement. So those who support that approach, the current operating performance approach to income measurement, believe that the unusual items should be closed directly to retained earnings. not included in computing net income. The accounting profession currently favors a modified all-inclusive approach to income measurement over the current operating approach, and this approach requires extraordinary items to be included in the income statement, but they are to be shown in a separate section. Additionally, the effects of any changes in accounting policies, the correction of errors, are to be shown as a retroactive adjustment of retained earnings on a net of tax basis. Discontinued operations. An entity is said to experience a discontinuance of operations when it disposes of a segment of its business. To qualify as discontinued operations, the assets, results of operations, and activities of a segment of a business must be clearly distinguishable, physically and operationally, from the other assets and results of operations and activities of the entity. So when an entity decides to dispose of a segment of its business, it must meet certain classification and disclosure requirements that have been established by the CPA Canada Handbook. The IASB, International Accounting Standards Board, defines a discontinued operation as a component of an enterprise that has been disposed of by sale, abandonment, or a spin-off, or is classified as held for sale, and A, it represents or is part of a plan to dispose of a major line of business or geographical area of operations, or B, they are a subsidiary acquired for resale. In addition, a component must be a major line of business or a geographical area of operations. So it can't just be a few assets of a business, it actually has to constitute a significant part of the business or geographical area. Discontinued operations are presented separately on the statement of income and comprehensive income, and also on the statement of cash flows, and they are also shown net of their tax effect. In discontinued operations, there's usually sort of an income statement and a balance sheet component of the discontinued operations. So the effect of the discontinued operation components results of operation needs to be shown separately from the results of the disposal of the component's assets. Usually there's a gain or loss on disposal, as well as a temporary or partial period income statement result. So those would be the results of operations, and they need to be shown separately. In terms of defining what an asset held for sale would be, it would include the following criteria. There needs to be an authorized plan to sell that part of the business, and the asset has to be available for immediate sale, so it has to be ready for sale, so whatever is necessary to get it separated from the rest of the business and ready to be sold to a buyer. There needs to be an active search for a buyer. The sale is probable within the next year. The asset is reasonably priced and marketed, so you need to determine some degree of reasonability. So management could separate a part of the business as a discontinued operation by separating on the financial statements, but if they don't really intend it, they intend to sell it, they could set it at a price that would not result in a sale. So the auditor, for example, and the users of the financial information need to determine whether that asset is really available for sale at that price. And finally, that the changes to the plan are unlikely in the circumstances. So for an asset to be identified as held for sale, it has to meet these criteria. So essentially, the auditor would have to be convinced by management that these criteria are met in order for the discontinued operations to be presented as such. Depreciation is not recognized for held for sale assets because they're not really part of the operations of the company. They're intended to be maybe maintaining the salability of the assets, but they're not really viewed as being the depreciation or use of the assets in the operations of the business. It would be remeasured at the lower of carrying value and fair value, so it would be reestablished at the lower value. That would be particularly obvious if the sale price or the requested sale price, the offer price, is less than the carrying value of the assets on the books. Once the asset is written down, then subsequent gains can only be recognized up to the amount of the original loss, and they should be presented separately on the balance sheet. ASPE says held for sale assets would retain their original classification as current or non-current. Under IFRS, held for sale assets are generally classified as current items. So the format of the income statement with the discontinued operations would look something like this. You'd calculate income from continuing operations net of tax, well, after tax. So the result from the continuing operations, you'd calculate earnings before tax and then take tax off of that as a separate item. So you're not showing individual line items on the income statement as net of tax, but you are showing individual line items in the discontinued operations as net of tax. So the income or loss from operations is shown net of tax, and the gain or loss on disposal of the assets is shown net of tax. So there's an income statement component and a balance sheet component. And that results in net income, because these things are included as part of net income. And then they would calculate earnings per share from continuing operations separate from discontinued operations, and the total earnings per share on the total net income would be calculated as well. So presentation of performance. The major elements of the income statement as described in Chapter 2 are revenues, expenses, gains, and losses. So the distinction between revenues and gains and the distinction between expenses and losses depends to a great extent on the typical activities of the business enterprise. When inflows or enhancements of assets result from typical business activities, generally the activities the entity is in business to perform, revenues result. So likewise, outflows or the using up of assets resulting from typical business activities will generate expenses. Non-typical business activities resulting in inflows or outflows of assets will normally generate transactions classified as gains or losses. Other comprehensive income includes revenues, gains, and losses that are not recognized in net income. So, however, as mentioned in Chapter 2, there is some discussion of whether other comprehensive income is a separate financial statement element, as it includes only other elements. So it doesn't include revenues, expenses, gains, and losses. Companies generally provide some detail on revenues and expenses on the face of the income statement, but they may prepare a condensed income statement, which we'll discuss briefly afterwards, with details presented in the notes to the financial statements. Companies are required to present expenses classified either by their nature, so nature of expense method, or their function of expense method. The function of the expense method is generally used in practice, but then the individual expenses are itemized in the notes to the financial statements. The International Accounting Standards Board takes the position that both revenues and expenses and other income and expenses should be reported as part of income from operations. Companies can provide additional line items, headings, and subtotals when such presentation is relevant to an understanding of the entity's financial performance. When the parent company's interest in a subsidiary company is less than 100%, the ownership of the subsidiary is divided into a majority interest, who own the controlling interest, and the non-controlling interest, the minority interest, and we'll be discussing that in more detail in Business 401, the Advanced Financial Accounting course. So in terms of basic presentation requirements, items that bypass the income statement are included under the concept of comprehensive income, and comprehensive income includes all changes in equity during a period except those resulting from investments by owners and distributions of owners, or distributions to owners, so dividends. The International Accounting Standards Board evaluated approaches to providing more information about other comprehensive income items and decided that the components of other comprehensive income must be displayed in one of two ways, either as a second income statement or as a combined statement of comprehensive income. The following items are required to be presented on the income statement: revenue, finance costs, share of profit or loss of associates accounted for using the equity method, another topic of discussion in Business 401. Tax expense, the amounts that the post-tax profit or loss of discontinued operations, and the post-tax gain or loss recognized on disposal of a discontinued operation, so the income statement and the balance sheet component of discontinued operations, and net income or net loss. There are two different formats for the income statement. The single step income statement, which basically doesn't separate out things like cost of goods sold to calculate gross margin, It shows all of the revenues, including gains, and all of the expenses, including losses. Income tax expense is often reported separately as the last item on the income statement. And the advantages of this method is it's relatively simple. It eliminates your requirement to conclude how to classify different kinds of revenues and expenses. The disadvantage may be that it oversimplifies the information. And if you're doing analysis on companies and trying to determine their profit margin, there's nothing as frustrating as trying to figure out what all of the components of cost of goods sold or cost of services sold would be. So you can see that that might be oversimplified in some cases for investment analysis. And it also provides less detail. So operating and non-operating activities are mixed together, and it's hard to determine which is which. So a single-step income statement is kind of classified here. Total revenues minus total expenses gives you net income, and then calculate earnings per share thereafter. So any unusual gains and losses, which are material gains and losses, would be disclosed as part of the regular part of other gains and losses, and wouldn't be shown separately in the single income statement approach, single step income statement approach. Material gains and losses that are either atypical or occur infrequently, but not both. So either atypical or infrequently, but not both infrequent and atypical, and are primarily dependent on decisions or determinations of management and owners, used to be called extraordinary items. And extraordinary items were disclosed separately, net of tax. And so the key components were they're not typical of the ordinary operations of the business, they don't happen very often, and they're not primarily dependent on decisions and determinations of management or owners. So management can't determine when they're going to record it and bias the income statement in one direction or another. Those would be extraordinary items. So we no longer use those terms under IFRS, and they're also not used under US GAAP effective 2015 either. So those items, unusual gains and losses, we use the term unusual gains and losses to include all gains and losses which are not typical of the business, or frequently or occur infrequently, whether or not they are primarily dependent on decisions or determinations of management. That used to be the key distinction between extraordinary items and unusual items, whether management can choose the timing of the event. If they could, it's an unusual gain or loss. If they can't, it's an extraordinary item. We no longer use that separated terminology. All items which are atypical or occur infrequently are disclosed as unusual gains and losses. If they're material, these items will be disclosed separately. If immaterial, they may be combined with other items in the statement because obviously they don't matter. Extraordinary items are material non-recurring items that are significantly different from the entity's typical business activities, and in the past under US GAAP they were presented separately on the income statement in order to provide enough detail to have predictive value. There were 3 criteria that had to be met for items to be considered extraordinary. They must be infrequent, so they occur infrequently. They need to be atypical of the company's normal business activities. They had to meet all of these criteria. They had to be unusual in terms of frequency, unusual in terms of the normal business activities, and they weren't allowed to depend mainly on decisions or determinations of by management or owners of the business. Under IFRS now, though, extraordinary items are not allowed. Under ASPE, there's no guidance with regard to extraordinary items or unusual items. All items are presented as income from continuing operations or discontinued operations, and the terminology extraordinary items is no longer used. So in terms of single step versus multiple step income statement, the income statement may be presented in either the single step format or the multiple step format. Single step income statements derive their name from the fact that total costs and expenses are subtracted from total revenues in a single step to arrive at net income. Income taxes are shown as a separate item among the expenses. Usually it's shown last to indicate their relationship to income before taxes. The multiple step format that separates results achieved by regular operations of the entity from those obtained by non-operating activities. So expenses are also classified by function, such as cost of sales, selling, administrative expenses. The multiple step format provides more detailed information for financial statement users than the single step format does. However, both are commonly found in practice. So the multiple step income statement shows operating and non-operating activities separately, and of course there are some clear advantages. It shows what is sort of the central part of the business, and so regular and irregular activities, and it helps you to predict future financial statements, future earnings in assessing the investment potential for the business. And it also provides feedback value, so you can identify things which are under control of management. Generally, operating activities would be a part of the stewardship of management, and it helps you to compare different companies. So, for example, Hudson Bay Company (HBC) does not include the cost of goods sold in their income statement, and that may be a choice due to competitive interest. They don't want to have their competitors have that information available to them, whereas other companies, I believe Sears Canada does provide that information on their financial statements. So in the past, my MBA students at Athabasca University used to have all kinds of trouble with a bunch of their ratio analysis, because HBC versus Sears was one of their common choices in terms of comparing Canadian financial statements. But the problem was that they didn't have the information for HBC, because HBC used a single step income statement approach, whereas Sears used a multiple step income statement approach. So one of the questions we always got was, how do I calculate these ratios that they don't give me the information for? And so our answer would be, well, if you don't have the information, you can't do the calculation, so you need to just basically say that's why you don't have these ratios included, and go on to use other methods to assess the performance of the company. So that's characteristic of single-step income statement companies. They're more difficult to analyze. So a multiple-step income statement uses more information, discloses more information, so it helps with ratio analysis. So particularly the inventory turnover is a relationship between cost of goods sold and average inventory. So if it's not shown, if cost of goods sold is not shown separately in the income statement, it's pretty hard to do that calculation of the inventory turnover ratio. So a multiple step income statement would be composed of various sections that relate to different aspects of the earning process. Companies might prepare some or all of the following sections. There could be a sales or revenue section, cost of goods sold section, selling expenses, administrative or general expenses, other income and expenses, financing costs, income tax, discontinued operations, so gains and losses resulting from disposal of a component of the company. Non-controlling interest shows an allocation of net income to the primary shareholders and the non-controlling interest of subsidiary companies. Earnings per share. The information content of the income statement may be further enhanced by adding additional sections, subsections to the above major sections. Other comprehensive income may be included if this information is not provided on a separate statement. Other comprehensive income plus net income is equals total comprehensive income. Can be combined into one statement, and it's commonly done that way, or it could be set up as a separate comprehensive income statement. Other comprehensive income includes such items as unrealized gains and losses on certain investments and certain foreign exchange gains and losses. So an example of multiple step income statement is shown here. We can compare that to the one we saw previously in slide 22. This is the single step income statement. Results in the same net income, of course, and the same earnings per common share. So the single step includes all the revenues and expenses separately, and the multiple step income statement classifies them according to their relative functions. So you can see that the multiple step income statement is quite a bit longer, quite a bit more information, quite a bit more detail. I've lost my place in my notes. I'll be back shortly. Okay, so discussing continuing operations, the detail of continuing operations, the continuing operations section is shown below here. The operating section would include net sales, cost of goods sold, selling, and administrative SG&A expenses. And then the non-operating section would include other revenues and gains and other expenses and losses, so they'd be shown separately. And a separate income tax section based on the income from continuing operations would be shown below that. So expenses would be reported on the income statement in condensed income statements. Condensed income statement basically groups the expenses on the face of the income statement, so it's a little less cluttered, and shows the detail in subsidiary schedules or supplementary schedules within the footnotes or the notes to the financial statements. So when arriving at net income, the statement presents the following subtotals: gross profit, income from operations, income before income tax, and net income. And then the company includes only the totals and components in condensed income statements, but prepares prepares supplementary schedules or subsidiary schedules to support the totals. So the idea here is it's concise and understandable, and it reduces the information overload. And so an example of that two-pager that we had before would look like this. So here we have a multiple step income statement which shows just the totals of all of the expenses. So rather than having a two-page income statement, we have it shown as a one-page income statement, and the notes, note D in particular, describes the details of the selling expenses. Nature versus function. IFRS requires an entity to present an analysis of expenses based on either nature or function. For instance, if the presentation is by nature, then depreciation and employee benefits would be presented without breaking down into a function, such as selling or administration. Conversely, presentation by function requires expenses to be allocated to an entity's functions, such as cost of sales, administrative costs. IFRS encourages presentation of this information in the income statement and comprehensive income, though it may be presented elsewhere as a schedule. Under ASPE, the presentation is not mandatory, but an entity may choose to provide it if it feels the disclosure would be decision relevant. Oops, getting out of order here. All right. Intra-period tax allocation. It's the intra-period tax allocation, so within the period, as opposed to inter-period tax allocation. So intra-period tax allocation refers to tax allocation for this period, and inter-period tax allocation would include deferred taxes or future taxes, which is a discussion that we will have in the second part of intermediate financial accounting, so business 354 as opposed to 353. So intra-period tax allocation is the process of relating the income tax effect on an unusual item to that item when it appears on the income statement. So income tax expense related to continuing operations is shown on the income statement as its appropriately calculated amount, not on a line-by-line basis, but on the total amount of continuing operations income. All other items included on the income statement, such as discontinued operations, extraordinary, unusual items, other comprehensive income, should be shown net of their specific related tax effect. The tax amount may be disclosed in the income statement or in a footnote. IFRS allows a company to present items included as other comprehensive income, either net of tax or before tax, with one amount shown for taxes related to all of the items, and the amount of tax may be shown on the face of the income statement or in the notes to the financial statements. Earnings per share. My notes are kind of falling apart here. Earnings per share. In general, earnings per share represents the ratio of net income minus preferred dividends, because those are committed before income available to common shareholders. So net income minus preferred dividends would be called income available for income available to common shareholders, often abbreviated IAC. So net income minus preferred dividends divided by the weighted average number of common shares outstanding for the period. It's considered by many financial statement users to be the most significant statistic presented in the financial statements and should be disclosed on the face of the income statement or in the notes to the financial statements. Per share amounts for gains or losses on discontinued operations must be disclosed on the face of the income statement or in the notes to the financial statements. And note that this area is of lesser relevance to private entities, as most have shares that are closely held. Therefore, ASPE does not include guidance on presentation of earnings per share numbers. The calculation, the numerator needs to adjust for preferred dividends because they get paid before common shareholders. So the preferred dividend amount, whether it's cumulative or uncumulative, is unavailable for common shareholders. Earnings per share is subject to dilution, which is reduction in the calculated amount if there are potential additional shares. So if the issue of additional shares is possible in the future, this would be in situations where there are convertible bonds or convertible preferred shares or stock options. They could result in additional common shares being issued, and that could be in excess of the amount of additional benefit. So it could actually be a situation where earnings per share is less if these potential shares were actually exercised, or were actually, if the potential share existed in real life. Then if that's the case, then we would show both a basic earnings per share number and a diluted earnings per share, obviously because existing shareholders want to know how much of the earnings per share is attributable to them, and if there's a risk that it could be actually diluted by other potential shares which could enter the business, then they would want to know what that lower level would be, because it's a more conservative measure of the earnings available to them. Retained earnings statement. The retained earnings statement is necessary because, of course, net income is closed out to retained earnings at the end of the period. So retained earnings shows the company's accumulated earnings or deficit over the entire life of the business, of course, less any payments that are actually made as dividends to shareholders. Under ASPE, the statement of retained earnings shows the accumulated income or deficit, as well as how much has been paid out as dividends. And recall that other comprehensive income only exists under IFRS, so not under ASPE. And OCI, other comprehensive income, is closed out to accumulated other comprehensive income on the equity section of the balance sheet. Therefore, under IFRS, we need an expanded statement that shows the changes in retained earnings and accumulated other comprehensive income. So under IFRS, instead of a statement of retained earnings, we use a statement of changes in equity, and we show all changes in all the equity accounts, including retained earnings and accumulated other comprehensive income, AOCI. The statement of retained earnings serves to reconcile the balance of the retained earnings account from the beginning to the end of the year, and can be combined with the income statement by adding it to the bottom. The important information communicated by the statement of retained earnings includes retroactive adjustments related to accounting changes, changes in accounting policies, and correction of prior period errors. It shows the dividend distributions for the period and any transfers to and from retained earnings. Retained earnings is often appropriated or restricted in accordance with contractual requirements or a board of directors stated policy. And the retained earnings section may therefore report two separate amounts: unrestricted and appropriated retained earnings. The statement of changes in retained earnings is a core GAAP statement, but it's not required under IFRS. So the statement of changes in shareholders' equity is a required statement under IFRS, but not under ASPE. It reports the changes in each shareholder's equity account and in total shareholders' equity during the year, including comprehensive income. It shows it in columnar format, so a column for common shares, a column for preferred shares, a column for retained earnings, a column for accumulated other comprehensive income. Changes will result from the results of additional share issues or comprehensive income or dividend declarations. So the following information must be presented in the statement: total comprehensive income, showing the amounts which are attributable to the owners and to non-controlling interests. For each component of equity, the effects of retrospective application of changes, so accounting policy changes or accounting errors. For each component of equity, it needs to show a reconciliation between the carrying amount at the beginning of the period and the end of the period, including profit or loss, other comprehensive income, and any transactions with owners. The entity may disclose an analysis of other comprehensive income by item, either in the statement or in the notes. In terms of what's happening now, plan changes in financial statement presentation. The IASB and FASB in the States have been working to develop a joint converged standard since 2004. It's been a while. In March 2006, the name of the project was changed to Financial Statement Presentation, and the IASB was in discussions on financial performance reporting and was in the research project stage. The IASB has since issued an exposure draft on the conceptual framework, which we discussed last chapter. This is still not finalized and remains open for comments at the time of printing of this textbook, which I believe was 2015. The exposure draft proposes to relabel the Statement of Comprehensive Income as the Statement of Financial Performance. That would be another change. So it's had a couple of different titles in my lifetime. This would be one more. And that is it for this chapter. So I was wrong. It's 2016 was the copyright date for this textbook. So the discussion around the Statement of Financial Performance has been ongoing for 12 years, up to the date of printing of this textbook. That's it. Thanks. Bye.